The best way to avoid tax with development involving your principal place of residence. I think that's about you subdividing your principal place of residence and using the subdivided land to maybe build another property or a few properties on it. The way that works is that you've got to pretty much carve off the place that's your principal place of residence. So get a valuation, get it measured, and that particular thing says your PPR, capital gains tax free. But then the developed part, you can say, well, how do I minimise my tax on that? And if you're developing it to sell it and make a profit, one of the techniques you can think about is actually setting up a separate company as a development company, which then contracts with you to develop the subdivided land and charges a market rate or commercial building cost. And that way you can legitimately move some of the profit away from you personally into a company and pay tax at 25%. And then when the development's finished and you sell the property, well, you've got a much higher cost base and probably much more reduced capital gains tax. Not a false economy, because if you're really going to develop it, you probably won't get the capital gains tax reduction. It'll be pure profit because you're a developer. So that technique means that you end up with part of your profits in your own development company and you got part of your profits in your own name, and that way you'll probably minimise the amount of tax you have to pay legitimately.